Let's begin with a story that is both deeply impressive and profoundly stupid. Back in 2010, a programmer named Laszlo Hanyecz made the first ever documented real-world purchase with Bitcoin. He bought 2 large pizzas. The price? 10,000 Bitcoins. At the time, worth about $41. A bit steep for 2 pizzas, but who are we to judge another man's Papa John's budget? The truly astonishing part is what those 10,000 Bitcoins are worth today, September 1st, 2025. Those 2 pizzas would now cost enough to buy you the entire Papa John's franchise, a controlling stake in Domino's, and still leave you enough to build a Neapolitan-style pizza oven on your private island. It's a perfect, almost painful illustration of Bitcoin's journey from a niche nerd curiosity to a global financial behemoth that makes traditional investors sweat. This single transaction encapsulates the maddening, exhilarating, frankly terrifying allure of Bitcoin, a story of monumental gains and face-palmingly gigantic missed opportunities. In 2025, the chatter is louder than ever. Is it a bubble about to pop like a supernova, or a rocket finishing pre-flight checks before liftoff? Here's a deal. If you're morbidly fascinated, subscribe to our newsletter. Do it now. Seriously, we'll send you an exclusive guide. How to spot a crypto scam. A document becoming more necessary every day. Digital self-defense in a wild west of memes. As of today, September 1st, 2025, Bitcoin is hovering around the $95,000 mark. Yes, you read that correctly. This comes after a rather turbulent summer that saw it dip into the low 80,000s, causing widespread panic among newer investors, and a smug "I told you so" from grizzled veterans. This recent volatility is a classic Bitcoin move. It's driven by a potent cocktail of macroeconomic factors like the Federal Reserve's latest ambiguous statements on interest rates. Its price chart looks less like a stable investment and more like an EKG of a patient who has just had a very strong espresso. The recent surge back towards the psychological barrier of $100,000 seems to be fueled by a renewed sense of institutional interest. We've seen a slew of filings for new spot Bitcoin ETFs from major asset management firms. It's the financial world's equivalent of the cool kids table finally inviting the nerdy kid to sit with them. Each new filing, each positive comment from a Wall Street CEO acts like a shot of adrenaline to the market. The resulting price action is swift and often merciless. A 10% swing in a single day is not just possible, it's practically a recurring Tuesday. This creates a high-stakes environment where fortunes can be made or lost in the time it takes to refresh a web page, which is precisely what makes it so addictive and so dangerous. You can't exactly price a gallon of milk in a unit of account that might be worth 10% more or less by the time you get to the checkout counter. This is why most people treat it not as money, but as a speculative asset, more akin to digital gold than a digital dollar. And while that narrative has been powerful, the recent price swings show that it's a very bumpy store of value, like trying to transport a Ming vase on the back of a dirt bike. Understanding this price action requires you to become a student of market sentiment, a quasi-psychologist of trader behavior. You have to track the fear and greed index. You have to follow the flow of Bitcoin onto exchanges. You have to follow the flow off exchanges. And you have to listen to the whispers on social media, where a single tweet from a prominent billionaire can trigger a market-wide buying frenzy or a catastrophic sell-off. It's an ecosystem where fundamentals are constantly at war with pure, unadulterated hype, and right now, the battle is as intense as it has ever been. Now we venture into the territory of prophecies and prognostications, a place where financial analysts and Twitter personalities with laser eyes compete to see who can make the boldest Bitcoin price prediction. And let me tell you, the predictions for the remainder of 2025 and beyond are, to put it mildly, all over the map. On one end of the spectrum, you have the permabulls, the true believers. Analysts from firms like ARK Invest are reiterating calls for Bitcoin to reach anywhere from 250,000 to an astronomical 1 million per coin within the next 5 to 10 years. Their argument is based on increasing scarcity after last year's halving event, plus an explosion in institutional adoption and even nation-state adoption. If Bitcoin becomes the world's primary store of value, market cap would have to swell to trillions, pushing the price of a single coin into the stratosphere. They see the current price of 95,000 not as a peak, but as a low-altitude base camp on the way to Mount Everest. On the other, much gloomier side of the street, you have the skeptics and the bears. Prominent economists call Bitcoin a speculative bubble with no intrinsic value, fueled by greater fool theory. They predict a spectacular crash, a Minsky moment, back to the low thousands or even to zero. They compare this to Dutch tulip mania of the 1630s and the dot-com bubble of the late 1990s. For years, governments and financial regulators treated Bitcoin with a confused mix of dismissal and suspicion, like an old man trying to understand a viral TikTok dance. Well, those days are definitively over. In the United States, the primary battle is between the Securities and Exchange Commission, the SEC, and the Commodity Futures Trading Commission, the CFTC. The SEC tends to view many digital assets as unregistered securities. The CFTC sees assets like Bitcoin as commodities. That bureaucratic tug-of-war creates a fog of uncertainty. The approval of several spot Bitcoin ETFs in early 2024 was a landmark moment. It was a tacit admission that Bitcoin is a legitimate asset for investment. Globally, the situation is a patchwork quilt. El Salvador continues its grand, risky experiment. Bitcoin as legal tender. China maintains a strict ban. The European Union offers legal certainty missing in the United States. Ultimately, Bitcoin's future may depend on whether regulators choose to build a bridge or a wall. Beyond the dizzying price charts, a quieter but equally important story is unfolding. The slow, steady creep of Bitcoin into the fabric of the real world. Major corporations are now allocating a small portion of their balance sheets to Bitcoin. This isn't just a speculative bet, it's a strategic decision to hold a non-sovereign, inflation-resistant asset. This global dichotomy is crucial to understanding Bitcoin's value proposition. For one person, it's a speculative play for generating wealth. For another, it's a defensive tool for preserving it. To truly grasp the forces at play, we need to talk about an event that is hardwired into Bitcoin's very code, the halving. This event, which occurred most recently in 2024, is a pre-programmed reduction of the reward that Bitcoin miners receive for securing the network. In simple terms, every 10 minutes a new block of transactions is added to the Bitcoin blockchain, and the miner who adds it gets a reward. The halving cuts that reward in half, an event that happens approximately every 4 years. There will only ever be 21 million Bitcoins. The halving ensures that the issuance of new coins slows down over time. With fewer new Bitcoins being created each day, the existing supply becomes inherently more scarce. If demand remains constant, or continues to increase, this supply shock logically puts upward pressure on the price. We are currently right in the middle of that classic post-halving window, which is a major reason why so many analysts are bullish for the end of 2025. However, the halving also puts immense pressure on the Bitcoin miners themselves. Their revenue was instantly cut in half. This forces a sort of Darwinian selection process within the mining industry. Only the most efficient miners can remain profitable, those with access to the cheapest energy and the latest technology. We saw a shakeout of smaller mining operations in the months following the 2024 event, leading to a greater concentration of mining power among large, publicly traded corporations. While the industry has consolidated, it has also become more geographically diverse, reducing the reliance on any single jurisdiction. So, after all that, we arrive back at our initial explosive question. Is Bitcoin about to go to the moon, or is it about to go up in smoke? The honest, if deeply unsatisfying answer is, nobody knows for sure. The current situation is a perfect storm of conflicting signals. We have powerful bullish indicators. The post-halving supply shock, institutional money flowing through ETFs, growing real-world adoption. At the very same time, we have significant bearish headwinds. The global regulatory environment remains a minefield of uncertainty, the ever-present threat of coordinated crackdown, and the sheer volatility continues to make it risky. It feels like a coiled spring, ready to leap. To say it's about to explode is probably accurate. The only question is whether that explosion is a launch or a detonation. To recap our key points, Bitcoin's price remains incredibly volatile but has shown strong upward momentum in 2025. Predictions range from wildly optimistic to apocalyptically pessimistic. Regulation is the biggest wildcard. Real-world adoption is quietly growing. These are the core dynamics you need to watch. They are the pieces on the chessboard. If you want to keep watching this bewildering, fascinating game with us, subscribe to our newsletter. We'll send you that free guide on spotting scams and continue to send you clear, no-nonsense analysis. As for what you should learn about next, Bitcoin Layers, the Lightning Network. This is where developers are building new functionalities on top of Bitcoin, aiming to solve its problems of speed and scalability. It's the next chapter in the story, and it may just determine whether Bitcoin remains digital gold or finally becomes digital cash. Good Good luck, you'll need it.